If you are collecting Social Security and still earning a paycheck in 2026, there is one number you need to know before your next shift, your next overtime check, or your next freelance payment. $24,480. That is the 2026 annual earnings limit for many people who are receiving Social Security retirement or survivor benefits and remain under full retirement age for the entire year. Go over that limit, and Social Security can withhold $1 in benefits for every $2 you earn above it. That does not mean you are forbidden to work. It does not mean Social Security takes half of everything you earn. And it does not mean the withheld money simply disappears forever. But if you misunderstand the rule, underestimate your earnings, or fail to report a change, your monthly deposits can suddenly be smaller than expected. In some cases, several checks may be withheld while Social Security catches up. The most dangerous part is that many people hear the phrase earnings limit and assume it applies to every dollar coming into the household. They count pensions that do not count, ignore bonuses that do count, confuse the rule with income taxes, or believe the limit disappears the moment they turn 65. Every one of those mistakes can create a nasty surprise. So stay with me, because I am going to show you exactly who the $24,480 limit applies to, what income Social Security actually counts, how the calculation works in real dollars, why a much higher limit applies in the year you reach full retirement age, and the special monthly rule that can protect people who retire in the middle of the year. And near the end, I will explain the part almost everyone gets wrong. Benefits withheld under the retirement earnings test are not necessarily lost forever. But they are also not normally handed back to you as one simple refund check. The way Social Security gives you credit is different, and you need to understand that before deciding whether to keep working, cut your hours, or claim benefits early. Before we go further, this video is about the retirement earnings test for Social Security retirement, spouse and survivor benefits. Disability benefits and supplemental security income have different work rules. Do not use the $24,480 number to make decisions about SSDI or SSI. Now let us begin with the basic rule. If you are under full retirement age for all of 2026, Social Security allows you to earn up to $24,480 from work before the annual earnings test begins, reducing your benefits. That works out to an average of $2,040 per month, but the standard rule is annual, not monthly. For every $2 of covered earnings above the annual limit, Social Security withholds $1 in benefits. Imagine you are receiving $2,000 a month in Social Security retirement benefits. That would be $24,000 in scheduled benefits for the year. You also work part-time and earn $36,480 during 2026. Your earnings are $12,000 above the limit. Divide that excess by 2, and $6,000 in Social Security benefits would be withheld under the earnings test. You would still keep all of the wages you earn from your job. The reduction applies to your Social Security benefits, not to your paycheck from your employer. This is why the phrase $1 for every $2 can sound more frightening than it is. Social Security is not taking half of your total earnings. It is calculating half of the amount above the limit, then withholding that amount from your benefits. The next question is the one that causes the most confusion. What counts as earnings? Social Security generally counts wages from a job and net earnings from self-employment. It also includes work-related payments such as bonuses, commissions, and vacation pay. That means a year-end bonus can push you over the limit even if your regular weekly wages seem safely below it. The same can happen with overtime, an extra seasonal job, consulting income, or a profitable self-employed side business. But Social Security does not count every form of income for this test. Pensions do not count, annuities do not count, investment income, interest, veterans benefits, and other government or military retirement benefits do not count toward the retirement earnings test. Do not confuse this with the federal income tax rules for Social Security benefits. Whether part of your Social Security is taxable is a separate calculation involving combined income. The retirement earnings test is about work earnings before full retirement age. These are two different systems with different definitions and different consequences. Now we need to talk about full retirement age because the rule changes dramatically depending on where you are on that timeline. Full retirement age is not automatically 65. It depends on your birth year. For people born in 1959, full retirement age is 66 years and 10 months. For people born in 1960 or later, it is 67. If you reach full retirement age during 2026, you do not use the $24,480 limit for the entire year. Instead, a higher limit applies to earnings received before the month you reach full retirement age. That higher 2026 limit is $65,160. For every $3 you earn above that limit before the month you reach full retirement age, Social Security withholds $1 in benefits. Notice the two major differences. The limit is much higher, and the reduction rate is $1 for every $3 above the limit instead of $1 for every $2. Also, only earnings before the month you reach full retirement age are counted for this version of the test. Suppose your full retirement age arrives in August 2026. Social Security looks at your earnings from January through July for the higher limit. If you earn $74,160 during those months, you are $9,000 above the $65,160 limit. 1/3 of that excess is $3,000. So $3,000 in benefits could be withheld. But beginning with August, the month you reach full retirement age, the earnings test ends. You can earn any amount from that point forward without your Social Security retirement benefits being reduced because of work earnings. Now let us deal with a situation that scares many new retirees. You retire in the middle of the year. Before retiring, you already earned $40,000, which is well above the $24,480 annual limit. You assume that claiming Social Security for the rest of the year is pointless because the annual limit has already been exceeded. That assumption may be wrong because Social Security has a special monthly earnings rule, usually used for 1 year, often the first year of retirement. Under that special rule, if you are under full retirement age for all of 2026, Social Security can consider you retired in any whole month when your earnings are $2,040 or less and you do not perform substantial services in self-employment. So a person could earn a large salary during the first half of the year, stop working, and still receive a full Social Security check for qualifying months later in the year, even though total annual earnings exceed the normal annual limit. For someone reaching full retirement age in 2026, the monthly amount under the special rule is $5,430 for months before full retirement age, again subject to the self-employment rules. Self-employment is where this becomes more complicated. Social Security does not look only at profit. It can also look at how much time and effort you devote to the business. The agency describes substantial services as generally more than 45 hours a month, or between 15 and 45 hours in a highly skilled occupation. That means a business owner cannot automatically assume that low reported profit makes a month count as retired. If you are actively working substantial hours in the business, the monthly rule may not protect that month. The special monthly rule is one of the strongest reasons to speak with Social Security before assuming that a mid-year retirement has eliminated your benefits. Give the agency accurate dates, expected wages, bonus information, and self-employment details. A correct estimate at the beginning can prevent months of confusion later. Now here's the question everyone asks. If Social Security withholds benefits because I earned too much, is that money gone forever? The answer is more favorable than many people think, but it needs to be stated carefully. When you reach full retirement age, Social Security recalculates your retirement benefit to give you credit for months in which benefits were reduced or withheld because of excess earnings. The agency adjusts the reduction factors that were used when you first claimed early. But do not expect a simple dollar-for-dollar refund to arrive immediately as one lump sum. The credit is generally reflected through a higher ongoing monthly benefit after the recalculation. How long it takes to recover the equivalent of what was withheld depends on your individual benefit, the number of months withheld, and how long you receive benefits. There is another possible benefit from continuing to work. Social Security calculates retirement benefits using your highest 35 years of indexed earnings. Each year, the agency reviews the records of beneficiaries who had wages reported for the previous year. If your new earnings replace a lower year in your 35-year record, Social Security can recalculate your benefit and pay an increase. According to the agency, any increase is retroactive to January of the year after you earned the money. That is why there is no universal answer to the question, should I stop working so I do not lose Social Security? For one person, reducing hours could preserve needed cash flow now. For another, continuing to work may produce more wages, strengthen the earnings record, preserve employer health insurance, and make financial sense despite temporary withholding. The right comparison is not simply wages versus withheld benefits. You need to compare total wages after taxes, the amount of benefits temporarily withheld, workplace benefits, health coverage, the possibility of a higher future Social Security benefit, and your household's immediate cash needs. Now let us talk about the mistake that creates overpayments. When you first claim benefits, you provide an estimate of what you expect to earn. But life changes. You receive unexpected overtime. Your employer pays a larger bonus. You start a side business. You return to work earlier than planned, or your expected income falls sharply. If you are under full retirement age and your earnings estimate changes, Social Security says to report the change right away. You cannot currently report that earnings change online. You can call Social Security at 1-800-772-1213 or contact a local Social Security office. Do not wait until the end of the year if you already know the original estimate is wrong. If Social Security paid benefits based on a low estimate and later learns that your actual earnings were higher, the agency may determine that you were overpaid and seek recovery. Reporting early gives the agency a chance to adjust payments before the overpayment grows. Keep records, save pay stubs, bonus statements, W-2 forms, self-employment ledgers, and written notes from conversations with Social Security. Record the date you called, what earnings estimate you provided, and any instructions you received. Here are the 5 checks you should make today. First, confirm your exact full retirement age. Do not use 65 as a shortcut. Your birth year determines the month when the earnings test ends. Second, separate work earnings from income that does not count. Wages and net self-employment income generally count. Pensions, annuities, investment income, interest, veterans benefits, and other government or military retirement benefits generally do not count for this test. Third, estimate your total 2026 wages honestly. Include bonuses, commissions, overtime, and vacation pay. Fourth, if you retired or will retire in the middle of 2026, ask whether the special monthly rule applies. The relevant monthly amounts are $2,040 for someone under full retirement age all year and $5,430 for someone reaching full retirement age in 2026, subject to the rule on substantial self-employment services. Fifth, report changes before they become overpayments. Call Social Security or contact your local office when your estimate changes. Let us bring the entire rule together in one clear summary. If you are under full retirement age for all of 2026, the earnings limit is $24,480. Social Security withholds $1 in benefits for every $2 of work earnings above that amount. If you reach full retirement age in 2026, the limit is $65,160 for earnings before the month you reach full retirement age. Social Security withholds $1 for every $3 above that limit. Beginning with the month you reach full retirement age, there is no earnings limit under the retirement earnings test. Only wages and net self-employment earnings, including items such as bonuses, commissions, and vacation pay, count. Pensions, annuities, investment income, interest, veterans benefits, and other government or military retirement benefits do not count for this specific test. A special monthly rule may protect qualifying months in the first year you retire, even when your annual earnings are above the normal limit. And benefits withheld because of the earnings test are not simply erased. At full retirement age, Social Security recalculates your benefit to credit months affected by withholding. Although that credit normally appears as a higher continuing benefit rather than an immediate refund of every withheld dollar. Working while receiving Social Security is legal, common, and sometimes financially smart. The danger is not the work itself. The danger is making decisions with the wrong limit, the wrong definition of earnings, or the wrong full retirement age. Check your numbers before the next unexpected paycheck changes your Social Security deposit, and share this information with anyone who started benefits early and still works. Because one accurate earnings estimate can prevent months of reduced checks, confusing letters, and an avoidable overpayment.